Hello, everyone, and welcome to this week's episode of Dollars with Sense. My name is Ela Lange, and I'm here with my fellow guru, Terence Vanderwood. Hi, Terence. How you doing today?
Well, I've got quite the hangover this morning, Ella. I was expecting the world to come to an end this week, and in some respects, it may have. What am I talking about? The 2016 U.S. election, of course. And this week we're going to do something out of the ordinary as we are discussing this particular event and what it may mean for the stock market and the Canadians in the next little while.
Yes, and with that, please remember that this episode is by no means fully comprehensive. It's based on statements and policy announcements released before and during the election campaign. There is no guarantee any policy proposal will be acted upon while President Trump is in office. What our intention today is to give you the financial facts if campaign promises are followed through.
So, the 58th U.S. presidential election is finally over. Donald Trump will be the next president, to the surprise of many observers, considering he trailed in most national polls in the weeks leading up to the vote. Riding on his coattails, the Republicans held on control of both the Senate and the House of Representatives. This sets the stage for a much more aggressive pursuit of Trump's campaign platform positions that would be possible in a divided government.
Among other things, the election sweep means a much higher likelihood of significant tax cuts, a boost to defense and energy companies, and a broad sell-off, especially of internationally exposed companies, due to policy uncertainty and the risk of a trade war. Historically, statistics suggest the stock market will react negatively to the Trump victory. Since 1928, the average annual return of the S&P 500, which is the top 500 equity companies trading on the U.S. stock exchange, during the first year of a Republican presidency is only plus 1%. By comparison, the average annual return during the first year of a Democratic presidency is plus 16%.
Yikes, that's a big difference. In the narrower sample of a new Republican president taking over from an outgoing Democratic presidency, first-year S&P 500 performance averages minus 10.2%, where a new Democratic president taking over from an outgoing Democratic presidency averaged S&P 500 performance in the first year of plus 8%. And these sources are from Strategas Research Partners, LLC.
Markets hate uncertainty. Trump has offered few specifics on major issues. On those economic issues that he has talked about, he's often retracted or even reversed positions. The populist rhetoric and lack of policy depth has led to expectations that a Trump presidency will be as erratic and uncertain in its style of governing as was his campaign. But policy uncertainty will, without question, lead to both higher market volatility, that's the ups and downs of the market, and apply pressure on market multiples and valuations.
What we are going to do right now is look at the specific campaign promises will have macroeconomic implications with Trump's significant economic proposals. For example, block the TPP, or the Trans-Pacific Partnership, renegotiate the WTO, or the World Trade Organization, and end or renegotiate North American Free Trade Agreement, or the NAFTA agreement. Another specific promise is imposing 45% tariff on Chinese goods unless yuan is allowed to float freely. Impose 35% tariff on Mexican goods to punish U.S. firms that outsource. Deport undocumented migrants, which would reduce the national labor force in the U.S. by about 5%.
Other promises was to reduce personal tax brackets, increase standard deductions, end inheritance and gift taxes, eliminate alternative minimum tax, tax capital gains and dividends, the top marginal rate, and close loopholes for the wealthy. He's suggesting to cut top corporate tax rates from 35% to 15%, And he's allowing firms to repatriate foreign earnings at 10% at a 10% tax rate or less. And he wants to close tax loopholes that benefit hedge fund managers.
The biggest risk to U.S. and global economic growth is trade policies. The Trump win proposes a serious risk to the U.S. economy if he follows through on his protectionist anti-trade rhetoric. Even with a Republican House and Senate, this is one area where Trump may find significant resistance to his proposals. With this threat to rip up existing treaties and impose new tariffs, even if there are limits to what he can actually be accomplished under executive authority, would disrupt global supply chains, jeopardizing the integrated international trade system that has been the key foundation of decades of global growth and prosperity.
Although Trump cannot rip up the NAFTA or other trade agreements on his own, there are a number of things he can do under executive authority. So that means without congressional approval. He can order the U.S. Department of Commerce to treat currency manipulation by foreign governments as a subsidy. The department could then impose tariffs or duties to offset these subsidies. He could declare a national emergency under the International Emergency Economic Powers Act, the IEEPA, if there's a threat to perceived security, foreign policy, or the economy of the U.S. This act allows the president to regulate or prohibit certain types of transactions, including imports, exports, currency, and credit transfers. He's also suggesting to restrict imports or impose import surcharges to deal with significant balance of payments owing to the U.S.
National security import restrictions. If the Department of Commerce investigation shows imports threaten to impair national security, he can also impose relief via tariffs if U.S. International Trade Commission finds an industry has been seriously injured by imports. It can also impose restrictions or withdraw trade agreement benefits, impose duties, etc., if the U.S. Trade Representative determines a foreign act or policy unreasonably restricts U.S. commerce. So pretty gray areas that can be stretched. A protectionist turn in the U.S. can be expected to significantly affect the broad market and multinationals in particular. To the extent that protectionism takes hold, one can also expect a rise in inflation, which would in turn lead to a rise in interest rates.
In his proposal of stimulus spending, Donald Trump has focused most of his talk of stimulus on his tax policies, rather than the infrastructure spending touted by Clinton during her campaign. It is generally thought that the significant tax reductions in his platform would be very stimulating in the short run, but the resulting sharp increase in government debt projected by the Committee for a Responsible Federal Budget, that's the CRFB, would put upward pressure on interest rates, creating serious problems for longer-term economic growth.
Trump has promised to repair the nation's bridges and upgrade its airports. When asked in August how much he would spend, he replied, quote unquote, at least double of Clinton's number, which her campaign had long pegged at $275 billion over the 5 years. However, he said he would, quote unquote, start a fund to raise capital from investors to pay for it rather than use government spending. Stimulus, if enacted, will take some of the burden of supporting the expansion of the Fed and its low interest rate policy. At the margin, it should lead to higher growth and in turn support ongoing dollar strength. However, government spending's contribution to the gross domestic product has now already been growing for 2 years, after being a net drag for over 4 years following the financial crisis of 2008.
Defense spending is already rising on a year-over-year basis for the first time since 2011. As for market implications, most anticipated beneficiaries of increased spending have already seen considerably more valuation expansion than the market as a whole. Because both candidates favored stimulus, it's already embedded in investor expectations. early outperformance of infrastructure stock may be a setup for disappointment down the road.
And then there is the taxes again. As detailed above, Trump has called for deep cuts to both personal income taxes and corporate tax rates in order to stimulate the economy, perhaps with negative long-term implications. When it comes to the idea of a repatriation package, Trump and the Republicans prefer to allow corporations holding profits overseas to bring them back with little or no additional tax. Any action on this issue would likely result in more share repurchases and dividend increases, as well as increased buyout activity as the cash is brought back to the U.S.
So this will bring about more federal debt. Trump's tax proposals are expected to add massively to the federal debt. Trump has waved off these concerns by suggesting the economy will boom under his plan, an assertion dismissed by most economists, who predict modest growth at best due to sluggish productivity trends, lower exports, and demographic realities. According to estimates from the CRFB, Trump's campaign proposals would add about $11.5 trillion to the public debt, bringing it from 74% to 127% of GDP by 2026.
The Fed, otherwise known as the Federal Reserve, is an institution that is charged with keeping the cost of living and borrowing in check through managing U.S. currency at a federal level. Trump flatly promised to ditch Fed Chair Janet Yellen at first available opportunity. Her term expires in early 2018. If operating with a clear lack of confidence from the White House or even open hostility from the president, there is every chance Yellen resigns before the end of her term. Recent reports show that she most likely will stay to the end of the term.
With regards to bond yields, so that's how much profit government and corporate bonds make for the investor, it's hard to predict which direction the net, or that safe haven flows, triggered by Trump's win, will move in the coming weeks. There are many reasons to expect bond yields to rise and prices to fall when the dust settles. The projected massive increase in the deficit under his spending tax and spending proposals will spook the bond market and put pressure on the U.S. dollar. Trump's loose talk during the campaign about defaulting on U.S. debt and his apparent lack of respect for Federal Reserve independence are also likely to reduce demands for U.S. assets.
Having said Yellen should be, quote-unquote, ashamed of the Fed's monetary policy stance, it is likely any successor Trump picks will be more hawkish than Yellen, a situation that markets will not react favorably to. Tax cuts, increasing spending, and higher inflation due to protectionist policies will all lead to upward pressure on yields. So, too, will potential dumping of treasuries by foreign governments upset at Trump's foreign policies.
Now, for emerging markets, China, Mexico, and any other country reliant on exports will bear the brunt of Trump's protectionist stance on trade. As for currencies, short-term weakness in the U.S. dollar might be expected if safe haven flows head to currencies such as the yen or the Swiss franc. Perhaps even the Canadian dollar might strengthen relative to the U.S. dollar in this scenario.
Interestingly, that's interesting. Interestingly and counterintuitively, in the weeks preceding the vote, as Trump's standing improved in the polls, safe haven flows seemed to move into U.S. dollars and treasuries rather than away. Longer-term, higher interest rates and fiscal stimulus will likely boost the greenback. Trump's changes of currency manipulation and threatening tariffs on exports from China and Mexico in particular will put renewed pressure on the yuan and the peso. But any developing world country that depends on exports to the U.S. will also see its currency pressured by his protectionist stance.
Commodities. Trump's support for coal likely means it should benefit, mostly at the expense of natural gas. Tough talk about Obama's nuclear deal with Iran may give oil prices a boost if investors begin to think that the agreement, which allowed Iranian oil back on international markets, will be scrapped. And in any period of heightened uncertainty, gold may see safe haven buying.
So what does this all mean for Canada? Canadians in particular have a lot at stake, given the United States is by far our largest trading partner. Historically, Canadian markets do worse under Republican administrations than they do under Democratic administrations. This should come as no surprise given the significant U.S. market performance preference for Democrats described above, or as we said before, and the high correlation between the U.S. and Canadian markets generally. Having said that, market history does not predict market future.
It's going to be a tough path for the Trans-Pacific Partnership, otherwise known as the TPP. Trump has called the signed but not ratified TPP a disaster. He's also said he would either renegotiate or pull out of the World Trade Organization. And under the president's Trade Promotion Authority process, or fast track, Congress would be required to give a simple yes or no vote on the 12-country TPP treaty once it is presented. Given Trump's characterization of the deal, don't expect him to present it. There is some talk that Obama could present it to Congress for possible approval in the lame duck session before Trump takes office, but that would likely not be received well given Trump's apparent mandate.
In general, less trade is bad for Canadian consumers, and without the TPP, most Canadians will be less off than they could be if the deal proceeded. In terms of businesses, non-ratification means less shipping, port traffic, logistics, and transportation. Some industries, such as food processors and restaurants, could have looked forward to lower cost imported supplies under TPP. Others, such as the seafood sector, have been anxious to see expanded access to foreign markets currently marked by high tariffs. On the other hand, some analysts believe no TPP is possibly good for the Canadian auto sector, which could lose some of its protection if the deal is implemented. So some good and some not so good.
What about NAFTA? In addition to his characterization of TPP as a disaster, Trump has said he wants to tear up or renegotiate the North American Free Trade Agreement, otherwise known as NAFTA. Talk of messing with NAFTA is a serious concern for Canadians, as the provisions of the agreement are extensively woven into almost all North American supply chains and trade patterns. Canadian trade with the U.S. has soared compared to our trade with the rest of the world after the deal came in force in 1994.
A recent report from the Export Development Canada, or EDC, suggested ripping up the NAFTA would be equivalent to a 10% across-the-board increase in tariffs. The EDC report estimates Canadian exports would plunge 4.5%. We would see a 4% drop in gross domestic product, or the GDP, and up to 737,000 jobs in Canada would be lost.
But before panicking over the threat to NAFTA, consider the following. In the 2008 U.S. campaign, both Obama and Clinton said they would renegotiate NAFTA, and it never happened. Congressional approval for ripping up the deal is highly unlikely given the degree to which major beneficiaries of the agreement are to be found in many or most congressional districts. When Trump criticizes NAFTA, it's usually in the context of railing against flows to and from Mexico, not Canada. Even if the agreement were reopened, it's not clear to what degree changes with Canada would be pursued.
That being said, the executive powers, what we talked about previously, can be directed at Canadian targets just as easily as they can be to Mexico or China. Furthermore, the more protectionist attitude in the White House may mean more restrictive, quote-unquote, Buy America provisions on U.S. government contracts, purchases limiting the opportunities for Canadian firms to participate.
The Keystone XL pipeline. Trump has said he supports the pipeline project rejected by Obama in 2015, but only if TransCanada gives the U.S. a quote-unquote big chunk of the profits or even ownership rights. It's not clear if that can be interpreted as actual practical support for the pipeline or not.
Other Canadian winners and losers. Beyond the implications for Keystone XL and companies dependent on NAFTA, there are a myriad of Canadian firms who do business in the U.S. and may see their opportunities expand or contract in line with the outlook of their respective U.S. industry counterparts. With that in mind, we're going to take a broader look at potential winners and losers by sector under Trump's policy proposals. So, the Trump winners will be energy. Trump supports opening up more areas for drilling, supports TransCanada Keystone XL pipeline, we think, and has spoken out in favor of coal and reduced energy regulation. Defense would also be a winner. Home security. Expect increasing intelligence work, more spending on defense, enforcing borders, and focusing on fighting ISIS. Another winner will be consumer discretionary. Benefits from increased spending spurred by lower taxes on low and moderate income workers.
Few other winners would be companies with offshore cash, so favorable reform on repatriation for taxes. Banks, Trump is critical of the Fed's easy money policies, so higher rates under a new Fed chairperson would boost bank profitability. Trump also opposes breaking up big banks and has said he would change or repeal Dodd-Frank. Private health insurers like medical device companies, Trump has pledged to repeal the Affordable Care Act, as we know, and replace it with private plans. An elimination of the ACA taxes on devices would boost device makers. Domestic companies will be hurt by international competition due to the protectionist anti-trade agenda. And infrastructure companies. Trump's proposal of massive infrastructure spending, including the building of a wall between the U.S. and Mexico, could be a boom for the construction industry.
So this is what we think the Trump losers will be. U.S. multinationals. Most U.S. multinationals will be put at a significant disadvantage in future trade deals, as future trade deals are scuppered and existing ones undone. Also suffering will be railroads and shipping companies, in particular those leveled to trade with Mexico and China. Alternative energy. Trump opposes wind turbines and doesn't believe in climate change. Look for the Republicans to roll back subsidies and tax breaks for alternative and renewable energy. Outsourcing companies will also be a loser. They will be hurt by tariffs on goods imported from Mexico and changes to H-1B visa program.
Housing. Expelling millions of illegal migrants will reduce demand for housing and rental accommodations. So tax reform proposals might curtail tax breaks for housing and raise mortgage rates through housing finance reform. Another loser might be pharmaceuticals, hospitals, and managed care. Trump supports legislation to allow price negotiation of Medicare prescription drug costs. The repeal of the ACA would hurt hospitals and managed care. Money transfer companies, so fewer illegal migrants, means fewer remittances to Mexico and elsewhere. And finally, investment banks will lose out after an initial flurry of volatility. Heightened investor uncertainty under a Trump presidency could push investors to the sidelines. Banks with capital markets and investment banking operations would be hurt by lower trading volumes.
Well, that was a pretty in-depth look at it all. Thanks to Stephen Rogers, investment strategist of Investors Group, for a well-written and thorough article. This is available to you, by the way, in PDF format on our Facebook page, Dollars with Sense. You can also listen to this or our 35 other episodes whenever you want from our YouTube channel. Just type in Ela and Terence into the YouTube search bar and you will find us. You can also email us at twofinancialgurus@gmail.com. That's the number 2financialgurus@gmail.com. Or finally, call us at 778-879-0820. Thanks to everyone again for bringing this all together so Ela and I, your two financial gurus, can bring you these useful episodes week after week. We look forward to giving you more valuable financial information and knowledge. But until then,
may your dollars and cents be with you.